Diesel price has doubled in just 3 months to 6 ringgit and 72 cents per liter. This is not just a local issue. It reflects broader global energy pressures that are now affecting one of the most important sectors in Malaysia's economy. The logistics industry connects ports to factories, warehouses to retailers, and suppliers to consumers. When fuel prices rise sharply, the effects do not stay within logistics. They spread across the entire economy. Diesel B10 and B20 are now priced at 6 ringgit and 72 cents per liter, while Euro 5 B7 is even higher at 6 ringgit and 92 cents. Just a few months ago, logistics operators were paying significantly lower prices, in some cases less than half of what they are paying today. For logistics companies, this kind of sudden and disruptive increase puts immediate pressure on profitability. Fuel is their largest operating cost, and in many cases, it can make up between 30% to 40% of total expenses. The situation is made more difficult by policy changes. The government has reduced diesel subsidies and tightened access through a targeted subsidy system. For logistics companies, subsidies are now distributed through a fleet card system. Under this system, approved vehicles are issued fleet cards that allow them to purchase diesel at a subsidized price, but only up to a limited quota. Once this quota is used, any additional fuel must be purchased at full market price. At the policy level, the government is aware of the situation and is taking steps to manage the impact. The National Economic Action Council is holding regular meetings to assess the situation and coordinate responses. While subsidies have not been removed entirely, the quota system means that heavy users are still largely exposed to market prices. There are several possible policy measures that could be introduced. Targeted relief for logistics operators could help reduce immediate pressure. Tax incentives may support companies in managing higher costs. Fuel hedging strategies could also be encouraged to reduce exposure to price volatility. However, these measures take time to implement and may not fully offset the impact of higher fuel prices. For logistics operators, the subsidy system provides only limited relief. While the fleet card allows access to subsidized diesel, the allocated quota is relatively small compared to actual fuel consumption. A single heavy-duty truck can consume large amounts of diesel in a short period of operation. This means that most of their fuel usage is still purchased at market price. This creates an immediate mismatch between costs and revenue. Many logistics contracts are agreed in advance and do not adjust quickly to sudden cost increases. As a result, companies may be forced to absorb higher fuel costs in the short term due to the unforeseen war happening. As fuel costs increase, logistics operators are left with limited options. One of the most immediate responses is to raise prices. Hauliers and transport companies have started increasing their rates across different services. This includes container transport, last-mile delivery, and specialized logistics. Refrigerated transport is among the hardest-hit segments. These vehicles require continuous cooling systems to preserve temperature-sensitive goods such as food, pharmaceuticals, and certain chemicals. The cooling systems consume additional fuel, which increases total operating costs. For companies in this segment, the cost pressure is much higher compared to standard transport services. Passing on these costs to customers is necessary, but not always easy. Smaller operators are facing even greater challenges. Unlike large companies, they often have limited financial reserves and less negotiating power with clients. Some are choosing to sell their trucks to reduce exposure, while others are scaling back operations or exiting the market entirely. There is also a regional dimension that adds another layer of complexity. In Sabah, Sarawak, and Labuan, diesel prices remain at 2 ringgit and 15 cents per liter. This is significantly lower than prices in peninsular Malaysia. The gap is almost 3 times. For companies operating across regions, this creates an uneven cost structure. Transporting goods within East Malaysia is much cheaper compared to the peninsula. At the same time, companies based in peninsular Malaysia face higher operating costs, which affects their competitiveness. This imbalance may influence how companies allocate resources and plan their operations. It may also affect pricing strategies, as businesses try to remain competitive while managing rising costs. This trend could lead to consolidation within the industry. Larger and more established players may acquire smaller operators or gain market share as weaker competitors exit. Now let us take a closer look at some specific companies that are directly exposed to these challenges. Freight Management Holdings Berhad operates as an asset-light freight forwarder. The company does not own a large fleet of trucks. Instead, it relies on third-party logistics providers to move goods. This business model offers flexibility, But it also means that rising transport costs are passed on to the company by its partners. If these costs cannot be fully transferred to customers, margins will come under pressure. Cross-border operations are particularly sensitive to fuel costs, which adds another layer of risk. Tasco Berhad is another major logistics player in Malaysia. The company has significant exposure to cold chain logistics, which includes refrigerated transport and storage. As mentioned earlier, this segment is highly fuel-intensive. Rising diesel prices increase operating costs significantly. If customers resist price increases, profitability may be affected. GD Express Carrier Berhad operates in the courier and delivery space. The company handles large volumes of last-mile deliveries, which require constant movement of vehicles. Fuel is a key component of its operating expenses. At the same time, competition in the delivery market remains strong. This limits the company's ability to increase prices aggressively. As a result, margins may be squeezed. The Association of Malaysian Hauliers has stated that pass-through cost is unavoidable. This means that higher logistics costs will eventually be reflected in the prices of goods and services. This is where the broader economic impact begins to take shape. When logistics costs rise, they affect every industry that depends on transportation. In the construction sector, materials such as cement, steel, and machinery must be transported to project sites. Higher transport costs increase the overall cost of construction. Developers may delay projects, revise budgets, or pass on costs to buyers. This can slow down the pace of new developments and affect property supply in the market. In the food industry, the impact is even more direct. Food products are transported multiple times along the supply chain, from farms to processing facilities, then to distribution centers, and finally to retailers. Each stage involves logistics. When fuel costs rise, the cost increases accumulate across the entire chain. This contributes to higher food prices, which adds to inflation. Retailers and manufacturers also face higher input costs. They must decide whether to absorb these costs or pass them on to consumers. If prices increase too much, consumer demand may weaken. If companies absorb the costs, their profit margins shrink. This creates a difficult balancing act, creating ripple effects across multiple sectors. Property developers may face delays and higher costs, which can affect project timelines and profitability. Consumer goods companies may experience margin pressure if they are unable to pass on higher costs fully. Even real estate investment trusts that are exposed to logistics and warehousing may be affected. If logistics companies struggle, they may reduce expansion plans or renegotiate rental terms. For investors, this is a period that requires careful observation. Quarterly earnings reports will provide important signals. Look at operating margins, cost breakdowns, and management commentary. These can give insights into how well companies are adapting to the new environment. Share prices may react ahead of earnings as the market anticipates weaker performance or slower growth. Understanding how cost pressures move through the economy can help identify risks early. It can also highlight potential opportunities, such as companies that are better positioned to manage costs or pass them on effectively. In times like this, resilience becomes a key factor. Companies with strong balance sheets, efficient operations, and pricing power are more likely to navigate the challenges successfully. As for consumers, higher logistics costs eventually translate into higher prices. Goods become more expensive as transportation costs are passed along the supply chain. This affects everyday spending and contributes to rising cost of living. To manage this, the government provides targeted subsidies for individuals and small groups. While logistics companies receive limited fuel quotas, individuals and small businesses may receive direct financial assistance instead. This support helps reduce the immediate burden, but it does not fully offset the impact of higher prices across the economy. In the short term, the outlook for the logistics sector remains challenging. Companies are dealing with higher operating costs, tighter margins, and uncertain demand conditions. Some are adjusting pricing, while others are restructuring operations to improve efficiency. At the same time, the effects are spreading across the economy, contributing to inflation and affecting business activity. Malaysia's logistics network is a critical part of its economic system. When fuel costs rise sharply, the entire system feels the impact. If you found this breakdown useful, please like and subscribe for more investment insights and the crises.